Hey Jordan, how you doing?
Good, Phil. How are you?
Not too bad. I think we'll have a few more folks tonight. We had about 200, a little over 200 register. So usually
Wonderful.
we found we get about maybe half that actually.
Yeah.
And so we're about 45 right now. A bunch of people registering or signing
Perfect.
on. So um, how about your partner? Is he on his way or?
Yeah, he should be on any second.
Perfect. Cool. So we'll wait for him and then we'll get going. Hello, everyone. Thank you for being here. We're just about ready to get going. Save your questions. I know you'll have a few um, till the end. Here comes Michael now, and he's just connecting in. Hey, Mark, how are you? Good to see you as well. Thank you for being here. Hey, Michael, how you doing?
Good. How are you, Phil?
Not too bad. So thanks for doing this. Really appreciate it. We've got, looks like about 70 people right now. Hey, Susan, how are you? Good to see you. Thank you for being here. We'll kind of appreciate all the hellos. We'll get started in a minute. Sometimes there's always a few people signing on a bit late. And we'll turn it over to Michael and Jordan. They're going to help you guys with your taxes, save you a lot of money, which is a good thing. And then we can do the Q&A at the end. So just we'll wait till we get there and we'll type in those. Hey Mawa, how are you? Good to see you. So cool. All right, guys, you wanna take over and kind of get going?
Yeah.
Sure thing. Let me share my screen with you. All right. Can you see that? Should be good to go.
Yep, absolutely.
All right. Hey, everyone. Thanks so much for having us this evening. My name is Michael Elliott, and I'm a CPA, and our team at the Agents Accountant, we work exclusively with real estate agents. And what we do is we help agents just like you keep more of what you earn and get rid of the stress that comes, always seems to hit right around tax season each year.
Exactly. And my name's Jordan Long. I've been in real estate for over 10 years. I actually hang my license at Dalton Wade as well. Um, I've owned short-term rentals, small apartment complexes, done fix and flips. So I've had all the headaches, the tax headaches of owning real estate, investing in real estate. But when I very first started out, I knew that I needed to sell houses and invest in real estate. However, I didn't think about the taxes or the bookkeeping side of things.
Yeah, and that's what we find happens with most agents. You're really good, pretty incredible actually at helping your clients build wealth through real estate, but oftentimes nobody is really teaching you necessarily how to treat your business like a business, especially from an income tax perspective.
Yeah, and that's what we're going to be talking about today. Just practical, high impact moves that make a difference before December 31st. So these are things you can do right now that'll set you up to pay less and feel more organized heading into the new year.
Yeah, so we call this session the smart moves that pay off big because a lot of what you're going to learn today, it's not complicated. It's just about being a little more strategic. So here's what we're going to dive into today. First thing we're going to talk about is we're going to talk about how to maximize your deductions. So that's the money and the deductions that a lot of agents miss or maybe are taking advantage of, but maybe don't have a good understanding. Second thing we're going to talk about is how to simplify your bookkeeping so that it's not overwhelming because we know for a lot of agents it's pretty overwhelming. So to make sure you're tracking everything correctly so that you can deduct it. Then we're going to talk about when does an S corporation make sense? When doesn't it make sense? We're going to talk about some year-end tax strategies. We've got a couple of year-end strategies that it's not too late. Even here on the 2nd of December, it's not too late to take advantage of these. And then the fifth thing we're going to talk about, the last thing, is how to plan for profit so that your business starts to pay you first.
Perfect. And we normally do these interactive, but I know we're going to have the questions at the end. So as we go through this along the way, if you think of a question that you want us to answer, go ahead and put it into the chat. And at the end of the presentation, we'll go through all those and answer them as best as we can.
Yeah, for sure. So let's start. with the one that everybody cares about, which is tax deduction. So here's the truth. Every single year, real estate agents just like y'all are likely leaving thousands of dollars on the table. Not because you don't qualify for deductions, but a lot of times it's because you just don't have the right systems in place to track and to claim everything that you're entitled to. So what we see with the tax code, right? The tax code is actually full of opportunities for business owners. And the IRS, while it seems like they're hiding these deductions, they're actually not hiding it, but they do require us to have good documentation and really to know where to look. And sometimes the IRS instructions, while they're not hiding it intentionally, it can be a little bit hard to understand where to look for different deductions. If you think about the current tax code with regulations, it's over 80,000 pages. Just imagine trying to find what your allowable deductions are in an 80,000 page tax code. So what we see is that it takes good organized work on the part of the agent in order to claim everything that you're entitled to.
Exactly. So that's what I found over the years. If I don't have a system in place to record my deductions, at the end of the year, I end up missing a bunch of my deductions at the end of the year just by not having a place to record them.
Yeah, exactly. I mean, you can work 80 hours a week as an agent, but if you can't prove your business expenses, you're going to be missing out on all sorts of deductions. So what we're going to talk about is we're going to talk about some of the commonly missed deductions that Jordan and I see in working with agents. And so the first one we're talking about is mileage. It's still, even though a lot of agents are taking it, it's still, you'd be surprised that it's one of the most commonly missed deductions by real estate agents. Here's why it's important, because every business mile you drive is worth about 70 cents in deduction. So that adds up fast. So if you drive 10,000 miles during the year, which every real estate agent basically is driving at least 10,000 miles for business during the year, that's a $7,000 tax deduction. And if you multiply that by 20, 30, 40% tax, you can see that adds up to real dollars real quick. This is not only one of the most often missed deductions for agents, but honestly, it's a deduction that if you were ever audited, is a deduction that's subject to a lot of scrutiny. So the IRS has pretty strict rules regarding the documentation that's required in order to claim the mileage deduction. So that documentation, just to give you an example, the IRS would say you have to have a mileage log, which shows the date of the trip, your starting location, where you went, the purpose of the trip. Really, it's going to be asking you for your odometer reading on the beginning and ending, because you got to know how many miles you drove. And while it seems like it's a lot of data to collect, the reality is that there's actually some really good and interesting technology that you can use to capture this information. There's some good smartphone apps we'll throw one out here in a second. And I can't tell you the number of times that I've done tax returns, for agents. And when I ask for mileage information, I call them up on the phone and say, hey, you didn't give me your mileage. What's your mileage for this year? And they always answer, oh, it's about 10,000 miles. And the reality is that could be how many miles they drove. But if we don't have sufficient documentation to prove those miles, you're going to lose out on that deduction if you were ever audited. So a program that you can use, it's a really, really good one. It's pretty cheap, that you could use to track your mileage. It's a phone app that you can turn on and off. And it'll ask you every time you get in the car, it'll ask you what the trip was for. It's called Mile IQ, Mile, and then the letters I and Q. Very cheap phone app that you can use to track your mileage automatically. So that's the first deduction that we find is often missed, is mileage. Second one is home office. If you've got a dedicated workspace in your home, and here's the key word, that's exclusively used for business, even if it's just a small corner of the office or it's just a desk in their office, it qualifies. So the key to this deduction is that your home office, however big or small, has to be used exclusively for your business. You can't be sharing it with your spouse who might be doing their hobby in the room. If you're going to claim it, it's got to be exclusive. And this is why we recommend that all agents allocate either a whole room for their home office, or at least a specific section of a room, and make that exclusive, and you can claim that portion. Now, here's why it's important with the home office deduction. It's because home office deduction adds up really quickly. The home office deduction, what it allows you to do is it allows you to take a percentage of your house's expenses as a deduction based on the percentage of your home office of your total house. So for example, if you have a 200 square foot home office and you have a 2,000 square foot home, then 10% of your qualifying household expenses are going to be eligible for deduction as a home office expense. And that is a lot of deductions. It's real estate taxes, it's mortgage interest, it's HOA, it's repairs and maintenance, and the list goes on and on and on. It adds up really, really quickly. And another thing to keep in mind, this deduction home office is not just for homeowners. If you're currently renting a home, you can also claim the home office deduction. Very powerful. A lot of agents are kind of scared about it because they think it might be an audit red flag. And we're going to circle back around to that here in a minute, and I'll kind of address audit red flags. The third deduction that we see often missed is this idea of meals and gifts. So meals, just for context, meals are 50% deductible whenever there's business discussed. And so meals are never 100% deductible. So if you go out to lunch, it's never going to be 100%. It's always going to be 50%. IRS always thinks there's a personal component to the meal deduction. So it's going to be 50% deductible, and gifts are deductible at $25 per person. Now, something to keep in mind with gifts, we know all agents, you're giving gifts regularly. Those gifts are deductible $25 per person. But remember, if you're giving it to a couple, it'd be $25 per person. So it could be $50 if they got kids. It keeps going up. And the other thing to keep in mind with gifts in particular is that if it's a marketing type expense, there is no cap on the deduction. And I have never met a real estate agent in my life who doesn't have some sort of branding associated with their gift. They're always looking for referrals. That's the name of the game. That's the heartbeat of the business. And so if we tie a marketing component with the gift, it becomes fully deductible. But that's one to keep in mind because we often talk about that limitation. So it's less of a limitation than you might think. The third one, or the fourth one, I should say, commonly missed deduction is actually in the education space. While it seems common sense, there's actually a little bit of nuance to it. But all of your CE courses, seminars like this one, professional coaching, if you have like a sales or a training coach, those are all deductible. And while it seems pretty straightforward, keep in mind that things like driving to a seminar, I know this one's online, but if you were driving to a seminar, the mileage on the way there would be deductible. Your Starbucks coffee on your way in, right, is going to be deductible. The notebook you bought to take notes are going to be deductible. We need to think about not just the class itself, but what are the kind of ancillary costs that go around that class. Those could also be deductible as well. We see those missed all the time. And finally, marketing. Everything from signs and staging costs, to your Canva subscription, social media ads, website hosting. It's often easy to miss the various marketing type expenses that agents often incur. So how often do you, if you think about it and you're going out to a showing, how often do you swing by Walmart on the way there because you got an open house or showing, you're picking up this or that and you forget, you put it on the wrong credit card, you're not getting a receipt, or you just forget about it altogether. That happens a lot. Or maybe you're buying something on Amazon, you forget which account it goes in. All of these things happen, but those expenses add up really quick. And we find most of the time those are marketing type expenses. And going back to putting it on the wrong card, this is why we're going to talk about it in a minute, having a dedicated credit card for use in your business, because it's important to be tracking all of those expenses.
And the key here is keeping good records. Most agents lose money simply because they don't keep receipts or track the details. So if you get nothing else from this section, just remember, you can't deduct what you can't document. Many agents are not tracking these items closely enough and are leaving thousands of dollars at the end of the year.
Yeah, so now I want to circle back to what I teased out a little bit earlier in terms of audit red flags. So the home office deduction, one of the biggest myths that I've heard in my 15 plus years as an accounting firm owner, working in tax practice specifically, is the home office deduction. I hear all the time from agents, from clients, I hear all the time, I don't take that deduction, meaning the home office deduction. I don't take it because I think it's a red flag. And honestly, maybe if we look back 20 plus years ago, maybe it was slightly a red flag back then. But in my career, I have never seen a tax return audited because of the home office deduction. In fact, I've probably seen 1,000 tax returns or more that had the home office deduction, and never one of them has ever been selected for audit because of that deduction. As long as you've got that dedicated space, even again, if it's just a desk or a corner, and it's used exclusively for business, it does qualify. And right now, with so many agents working from home, almost every agent is going to qualify for the home office deduction. So if you're not taking this on your return, we'd highly encourage you to take a look at that. Another point I want to make is that even if you have another office, so maybe you're renting space somewhere, you got another desk somewhere else, you can still claim the home office deduction. You can have both. There's also a simplified version of this deduction. If you're like, hey, Michael, I don't want to track all of my personal like utilities and personal home expenses, that's fine. There is a simplified version that you can take. It's just $5 per square foot based on the square footage of your office. So talk to your tax professional about that, because the simplified version may be good for you. Going back to the whole idea of red flag, in all honesty, if we're talking about red flags that could impact your tax return, the biggest red flag is actually going to be on the mileage side of things. If you're claiming that, hey, I drove 10,000 miles during the year, that's probably a much bigger red flag. And I've seen multiple audits come down on that, never on the home office deduction. So home office deduction, very powerful. Claim it. If you're not, you probably should be. So now I want to transition to something Jordan mentioned just a second ago, and that's what we call our golden rule of deductions. I'm going to repeat this because it's that important. You can't deduct what you can't document. You can't deduct what you can't document. Even good, appropriate deductions, they're completely worthless if you don't have documentation to prove that your expense was for business purposes. I've seen in audits before where the IRS agent sits there and says, Michael, your client, I know that they spent this money. Like, it's obvious. They're a real estate agent. They had to have had miles, right? They had to have had business miles. But if the real estate agent can't quantify it, can't substantiate the deduction, the IRS auditor is not going to allow it. You see, in an audit, the burden of proof is on the taxpayer, not on the IRS. And so what that means is that the IRS does not have to prove why you can't take a deduction. You, as the taxpayer, have to prove that you can take the deduction. So this is why we call this the golden rule of deductions, because you can't document you can't deduct what you can't document. We thought about throwing a picture of an IRS auditor up here for our golden rule, but honestly, golden retriever puppies are much cuter for our golden rule deductions. We thought you'd remember it a little bit better. So what we recommend is that you create a system to track your deductions, something that works for you. If you're more of a visual person, maybe you're taking pictures of receipts on your smartphone and just storing them in an album, called tax stuff. Or if you're more digitally inclined, maybe you're using tools like QuickBooks Online, and we'll talk about that in a second, Xero, or even a shared Google Drive folder. The simpler the system that you put together is, the more likely you are to stick to it. And that's really what separates agents who maximize their savings from the ones who are overpaying on their taxes every single year. You just don't have a system. So what we said in the beginning is, it's often not just the hustle that separates the good from the great agents. It's the hustle combined with good systems, good processes, and good strategy.
All right, so let's jump into some bookkeeping here. And I know this is where a lot of you guys want to take a nap, but stay with me, because this is where the stress of tax season really goes away. When your books are messy, you're guessing, you don't really know how your business is performing. But when you keep up with your books, even if it's just once a month, you actually see what's working and what's not. Bookkeeping is often one of the first things that goes away when agents get busy. And the reason for that is most agents don't have a clear and simple system for bookkeeping. But while it might seem boring, bookkeeping actually does two different things for you. First, it provides you with a good systematic method for capturing all of your allowable expenses, which will, at the end of the year, allow you to minimize your income tax obligation. And the second thing that bookkeeping does, it allows you to understand how your business is doing.
Yeah, so the way I like to think about bookkeeping, as an accountant, is I like to think about bookkeeping like checking the dashboard on your car. We don't wait until our car breaks down before we look at our dashboard, right? We're glancing at our dashboard constantly, like as we drive, when we get in the car, we're looking at it constantly to make sure that everything's running right, to make sure that there's no warning lights saying, hey, look, something might be a problem. I can't tell you the number of agents that I've worked with who thought maybe I'm doing well financially, but they're never looking at their financial statements to really understand, what do the numbers actually say? Am I actually doing well financially? I know there's gross commission income, it's coming in, but are my expenses higher? They're never looking at these profit and loss statements. They're never looking at their balance sheet statements throughout the year to see if maybe there's something wrong. In fact, I would say this is even if you're not the best bookkeeper in the world, even if you're doing just a mediocre job at your bookkeeping, it's still a mediocre bookkeeping job puts you in a substantially better position than someone who doesn't put any time into their bookkeeping at all.
Exactly. It's not about perfection, but it's about visibility into your business. So here's some 4 rules for us. Here's a simple system that we've built that we believe works well for real estate agents. It works because it's simple and repeatable, yet complex enough to help you get insight into your business and properly track your expenses. The 4 main pillars of the system is separate bank accounts, use one personal or one business card, use software, and do a 15-minute review. And that's all you need to do to stay organized. So the most basic fundamental element of this plan is having separate business and personal bank accounts. That means that you have a checking account for your business and one for your personal expenses. You pay all of your business expenses through the business account and the personal through the personal account. Mistakes happen, but having those accounts separate is key to having good bookkeeping. The second element is having one dedicated card for business. Ideally, this would be a credit card issued in the name of the business. However, if you want a personal card to use a personal card for business, just make sure that you're only putting business expenses or business transactions on that card. If you get into the habit of always using business credit cards for business expenses, you'll be a lot less likely to lose those expenses because you put them on the right card. And if you're prone to forget this, you could be like Michael, who reminds himself is like blue for business because his blue business card is in his wallet, and that's how he remembers.
Yeah, so that's exactly right. Business credit card, having a separate dedicated business credit card, one of the biggest keys to capturing all of your deductions. So the third part of our plan, kind of our simplified business bookkeeping plan, it shouldn't be seen as groundbreaking anyway, and that's to simply use software. Use software. So accounting software has gotten super good at helping us track our data. We recommend that all agents use software like QuickBooks Online. QuickBooks Online is our recommendation for almost every agent because we just think it's the best product on the market. Use that to track your transactions. QuickBooks Online it's a powerful piece of software. What it does is it connects directly to your bank, your credit cards accounts, and it pulls those transactions directly into the software. It can even help you start to categorize your transactions. So, for example, you can go out to the restaurant, swipe your credit card. We all know that the credit card transaction shows immediately up in your credit card account. That your credit card then sends it right to QuickBooks. Then you're swiping the card at the restaurant. It's showing up in QuickBooks. QuickBooks then can help you take that expense. It sees it in QuickBooks. And then the AI and some of the technology, the rules built into QuickBooks can actually start to suggest and say, okay, you went to XYZ restaurant. That's probably a meal expense. And you can go in there and say, yes, it's a meal. And so as the technology is getting better, it's getting quicker and quicker and quicker to do our bookkeeping. So most agents, what we find is that most agents who set up a good bookkeeping system, something simplified like this, can do their bookkeeping in less than 5 hours per month. And most agents are able to get to the point where they're able to do it in 2 hours or less a month. The other benefit to using software is you can attach copies of your receipts. We talked about taking pictures and things. You can attach copies of those receipts directly to the transaction inside of QuickBooks. So again, going back to the restaurant, you swipe your card, take a picture of the receipt. You can just upload it using the app right to the account, attach it right in there. And then if you're ever audited or you want to look at your profit and loss statement, you can easily pull out the transaction and immediately see the expense, what it was for, etc. And honestly, there's almost no downside to using software. The only downside would be that there's a price associated to the software vendor, but that cost is so low compared to the time savings that you're gonna get out of not waiting until the end of the year to do all your bookkeeping. If you're able to keep up with it on a month-by-month basis, the cost you're going to pay for this is worth every single penny. So the fourth and final part of sort of our simplified bookkeeping system that we talk about is the 15-minute review. So what we do is we recommend that all agents, after you do your monthly bookkeeping, again, you should be doing it in less than 5 hours a month. After you do your monthly bookkeeping work, just take 15 minutes. to review your numbers. Using QuickBooks Online, you can review a profit and loss statement. You could review, for example, we're sitting here in early December. You could review your November numbers. You could also review January through November. You can compare January through November against the prior year. All that is at the click of a button. You can also review what's called a balance sheet report. It's another financial statement report. It's important to look at. It shows all of the items you own and the liabilities you owe. So it shows you kind of your net worth in your business. Another incredibly valuable one to take a look at. Sometimes we do get asked by agents like, hey, how often should I be doing my bookkeeping? Like, when should I be completing my bookkeeping? Our recommendation is you do your bookkeeping every month. For a lot of agents, if you're doing a good number of transactions, you maybe want to think about updating your bookkeeping even more than once a month. But at a minimum, you should be doing it once a month. And we recommend you do it in the first 2 weeks after the end of the month. So we're sitting here early December. You should be doing your bookkeeping kind of by mid-December, so that November should be done by about mid-December. That gives you enough time to get it done, but it's not so much that it's so far past that the data is old.
Exactly. And that's it. Those are the 4 pillars, or the 4 foundational pillars of a simple bookkeeping system that real estate agents can use to make sure they're not only tracking their deductions, but giving themselves the data they need to make sure they're running a profitable business.
Yeah, that's exactly right. So now we're going to talk a little bit about structure. It's specifically, when does an S corporation make sense? Some of you might be like, yeah, S corp, I'm already doing that. Some of you may be like, S corp, I have no idea what these guys are talking about. We'll try to break it down for you. It's a little bit complex, but it's a huge tax savings tool that a lot of agents can take advantage of. So it's honestly one of the most misunderstood areas for agents, because we hear people say all the time, you have to be an S corp to save on taxes. And that's not always true. But when it's done right, it can save you thousands of dollars every year. Now, before we jump right into talking about the tax benefits of becoming an S corporation, we always want to back up and talk about what a legal entity is and why that's important. But first off, and this should be apparent by listening to us talk, Jordan and I, we are not attorneys. We do not play attorneys on TV. So always get legal advice from your legal counsel. That's going to be your best option, because even if we wanted to give it to you, it just frankly probably wouldn't be good legal advice, because we're not attorneys. We don't know what we're talking about. But we've worked with thousands of clients, and we've worked with dozens of attorneys. And so we understand entity structure. So I want to break it down for you just a little bit. So first off, there's, when we think about types of entities, there's 2 common types of entities that a business can become, and your state authorizes you to become an entity. So the first type of entity is an LLC, limited liability company, LLC. And the second type is corporation. Almost always, real estate agents, they choose to operate as an LLC and not as a corporation. Different states have different rules and regulations, so you got to figure out that, how you're issuing your license, etc. But those are the 2 common types, LLC and corporation. They're both legal entity structures given to you by the state. Now, corporations tend to have more legal requirements to operate, which is why many agents choose LLC. So most agents, when you're just starting out, actually don't set up a legal entity at all. Many just operate out of their personal names. And we don't think that's super advisable for most agents. Again, it's going to depend on your state, but for a lot of agents, it's probably not advisable, because operating under your personal name is going to significantly limit your income tax strategies as you grow. And so if you're growing, becoming an LLC is probably something you should think about talking about with your attorney. Now, notice so far that all I've talked about is LLC and corporation. I haven't even talked about S corporation yet. So here's what an S corporation is. S corporation is a subsection of the Internal Revenue Code. And what that means is that it's a section of the code that lets your business entity, so that LLC, file income taxes using a somewhat more complex but much more tax advantageous structure. So in order to elect to become an S corporation, you have to be a business entity. So you have to be an LLC or a corporation. That's first thing right off the bat. Meaning an S corporation, this strategy is not available to you if you're running and operating your business under your personal name. Now, again, since most agents choose to operate as an LLC, we'll talk about it from that perspective. So, if you operate as an LLC today or under your personal name, here's what's happening. All of the net profit from your business, and net profit is your total income, your gross commission income, minus all of your expenses, those deductions we talked about, that's your net profit, right? And that net profit is taxed in 2 different ways. The first way is that ordinary income tax, just it's going to be your federal tax rate. And so for our case study we're going to talk about here, let's say it's 20%. That's the first tax. The second tax is what we call self-employment tax. That's Social Security and Medicare tax. And the total that you pay on that is 15%, meaning if you're in the 20% tax rate, you're paying 35% tax between your income and your self-employment tax. So on a net profit, again, revenue minus expenses, that's $35,000 a year in income and Social Security and Medicare taxes. So this is where an S corporation really comes in, because if you elect to become an S corporation, what we do is that income moves off of your personal return and the S corporation files its own tax return. So then what the S corporation does is it has to pay a reasonable salary to its owner. IRS doesn't define reasonable salary for us. Your accountant can do that for you, help you to do that. And so let's use our example from earlier. Let's say your business has that $100,000 in net profit. You elect to become an S corporation. And what you do is you determine that $60,000 is the amount of reasonable salary that your business needs to pay you. So what the business does then is the business pays you a W-2 payroll in the amount of $60,000 throughout the year. And what happens, that payroll, of course, is subject to Social Security and Medicare tax at 15%. So we're not saving anything on that 15%. And that W-2 payroll is, again, showing up on your personal return. So on the $60,000, you're still paying the 20% and you're still paying the 15%. But here's where the magic of the S corporation comes in. The remaining $40,000 is still going to flow down back to your personal return, and you're going to pay ordinary income tax on that $40,000 difference. But here's the key. That $40,000 difference is not subject to Social Security and Medicare tax. So you're saving 15% of that $40,000. So for just quick math, 15% of $40,000 is $6,000. And so you can save $6,000 on your annual tax bill by doing nothing more than electing an S corporation status and paying yourself a reasonable salary. So you can quickly see how the S corporation strategy adds up to real money. Now, there are some additional costs. Don't hear that I'm saying that there's no cost to it. There are additional costs to becoming an S corporation. You got a separate tax return that's got to file. You got to put yourself on payroll. So you got some payroll tax filing. And so there are costs that are associated with being an S corporation. But here's what we find. We find that when your net profit in your business starts to exceed $50,000, usually the benefits of being an S corporation start to outweigh the costs. And so if you're sitting there today and you're saying, hey, my net profit, gross revenue minus expenses, is around $50,000, then you should be talking about and thinking about electing S corporation tax status, because it can probably save you significant tax dollars. So want to transition now to talking about sort of a few what we call smart moves that you can make before December 31st, before it's too late. This is kind of a year-end checklist. These are 4 ideas. They're not applicable to everybody, but I want to run through them because these are some strategies you can look at. So the first thing is, if you've got a bunch of net profit this year and you're sitting there saying, like, I don't know what to do, I'm going to owe a bunch of taxes, I don't want to pay a bunch of taxes. Here's some ideas. First thing you do, prepay your expenses. If you know that you're going to buy supplies, renew the MLS, pay for marketing early next year, maybe you got a sales or train coach or something like that, you can potentially prepay those expenses this year. So if you're like, hey, I had a bunch of closings this year, or I got a big closing right before the end of the year, I know I'm not going to have next year, I know my income's higher this year, you might want to think about prepaying some expenses. As long as you're using that expense in the next 12 months, the IRS doesn't care that you're taking the deduction this year. You all are going to be considered, for the most part, cash basis taxpayers, which means you deduct things in the year that you spend the money. And so prepaying expenses is a great idea. And also, there are times when you can get discounts and things from vendors if you're prepaying your expenses. So prepaying your expenses, a huge opportunity for a lot of agents. The second thing you can do, and this is not a common one, but I always want to throw this one in there because I have seen a couple of really interesting case studies on this, is to delay your income. If you've got a closing that's maybe going to happen right around the end of the year, there's a potential that you could delay that commission income into the following year. We never would recommend that you do this to the detriment of your client. However, if this is a transaction that you're associated with, most of the time this maybe be your own transaction or a family member's transaction where they don't care the year that it closes, you can potentially balance the year because remember, you're going to pay income tax on the year that you collect that money. And so potentially delaying income is a possibility, especially if it's one of your own transactions, something to really think about doing. The third kind of year-end thing that you should really consider doing, contributing to a retirement account. If you're self-employed, you can use and got some good net profit, you can open like a solo 401k. Sometimes they're called single Ks, or a SEP IRA, and you can deduct contributions up to sort of the maximum limits. And for that solo 401k, the single K plan, you can contribute up to $70,000 into retirement. So just imagine $70,000 times 35%. That could be a $25,000 tax savings by putting $70,000 into a retirement plan. But the reason this is something you need to consider before the end of the year, some of these retirement plans require them to be set up before December 31st. So if this is something you're thinking about doing, you want to have that discussion with a financial advisor. If you've got one, you want to have the discussion with your tax professional to make sure that everything is set up and ready to go before the end of the year. And the fourth kind of year-end smart strategy we like to look at is maybe buying some business equipment. So things like computers, cameras, even vehicles. Vehicles can be a little bit complex. The rules around them are a little bit complex, but all of those things are going to be deductible currently. Where we sit here in 2025, we have something called bonus depreciation and something called Section 179 that lets us effectively write off 100% of the cost of most assets. I have to put a little asterisk by most because vehicles are one that there's specific rules and regulations around. However, most equipment and a lot of vehicles are eligible for huge amounts of depreciation, even if you put them into service on December 31st. So even if you go out and purchase something on December 31st, we could be eligible to take 100% of that deduction this year, even though you didn't own it for the whole year. As long as it's in service in the calendar year, it's deductible this year. Another thing to keep in mind is that assets are deductible even if they're not paid in cash. So even if you're putting it on a credit card, or even if you're taking a loan out in the case of a vehicle, IRS doesn't care as long as it's titled and in service by December 31st. That could be an eligible business expense for this year. So that could be a smart money move to make as well. Talk to your CPA. They can walk you through all of the different kind of complex requirements that you have to look at.
Perfect. Yeah. And those are simple, like legit timing strategies. They don't change your income. They just change when you recognize that money. So let's finish strong here. Let's talk about some planning for profit. So we get in the business to make money. So we want to plan for profit. When I started out, I treated every commission check as a personal bonus. And then when tax time hit, I'd be left scrambling. So we got to tell our money where we want it to go. And so there's 3 basic accounts that we recommend agents open up if they don't already have them. Those 3 accounts are an operations account, a tax account, and a profit savings account. So the operations account is where we want your commission to land and expenses to be paid out of. This account is essentially your main business checking account. This is where most of the action is going to take place. We want that tax account. So whenever you get paid, we want 25 to 30% to be transferred immediately. This is where this is a separate savings account in the name of the business where you'll save all your money that you'll need to pay for income tax each year. We usually recommend that agents transfer somewhere between 25 to 30% into that account. And this amount can vary on your own situation. So talk with your CPA about it. You'll move the money from this account back into your checking account when you need to pay your quarterly estimated payments or your end of year tax bill. So this account should be earning you some interest. It should be like a low risk CD or mutual fund for that account. The next account we recommend you having is a profit savings account. So this is where we move 10% of the money every time you get paid into this account. This money is the money that you're setting aside for strategic initiatives, for investing back into yourself or your business. These funds could be used for things like retirement plans, coaching, consulting, sales training. This is the profit that you're wanting to reinvest into the business. Or if you don't have anything that you're wanting to invest in, you could use these funds out of the business for additional owner's compensation.
Yeah, so those are the 3 business accounts that we're going to recommend that you have set up. And what we're talking about here is we're really talking about sort of the mental exercise of moving money around between accounts. And the reason we do that is when we get a commission check in, we want to designate that to different accounts. And the reason we do that is it builds discipline in us from a psychological perspective that, hey, all of this money is not, as Jordan said at the beginning, it's not just like freebie bonus money. Like, we need to dedicate and allocate this money to income taxes. We need to dedicate and allocate this money to savings. We need to move money to our personal account and just be disciplined about it. So the fourth account that we like you to have, and it should be obvious at this point, is a personal spending account, right? This account is not a new account. This is not a new business account. This is your personal checking account. This is where you're going to pay all of your non-business bills, your groceries, your household bills. They're all getting paid from this account. And what we recommend is that agents transfer every month a certain dollar amount that you need to cover your personal expenses, move it from your business operations account to your personal account, and as best you can, try to live that month from that personal savings account. Because we believe, again, that if you tell your money where to go, it's going to behave better than when we simply spend at will from whatever account we want. We're mixing things all together. The amount you transfer here from the business to the personal, it's going to depend. It's going to vary depending on where you live, your personal situation. But we often see this as around maybe 40% of your total each month. And if you do the math on that, right, we're moving 10% to the profit account, 30% to our taxes account, 40% to the personal account. That leaves around 20% of our money to sort of cover our normal business operation expenses. And those funds should be left in sort of the business operating checking account used to pay those normal monthly expenses. And that's it. We find that this system removes like 90% of the stress of cash flow that agents often face throughout the year.
Yes. And when you set aside money for taxes and profit first, you finally feel in control. It's not about how much you make, but it's about how much you get to keep. Consistency beats complexity every day. You don't need 12 accounts or a fancy spreadsheet. Just commit to doing the basics. Same way you follow up with clients or track listings. Oftentimes we see agents that want to make things more complex than they need to be, and they get overwhelmed and never do anything. So our advice is to create simple, repeatable systems that allow you to move slowly in the right direction. We talk about systems so often because we have seen that they work. They work to help you have peace and control in your business and help you to grow and achieve all the wealth goals for yourself.
Yeah. So let's kind of recap what we've covered today. We talked about tracking and documenting everything. If you can't document it, you can't deduct it. We talked about keeping your books simple and clean, repeatable systems and processes. We talked about considering an S corporation when your income hits that $50,000 level. Really consider that powerful tool. We talked about a few year-end tax savings, accelerating, prepaying expenses, delaying income, opening retirement accounts, etc. Things that you need to think about before December 31st. And finally, we talked about paying yourself with purpose. These aren't complicated steps, but together, these things, they build, a solid foundation for long-term financial growth and success.
Exactly. And as a real estate agent, you're already building wealth for your clients when they're buying houses. So the systems we've laid out today helps you build your wealth.
Yeah. So what we've done is we put together, a free checklist that summarizes everything from today. So that's the year-end tax playbook checklist. If you scan that far left QR code on your screen, you can grab that. It's going to take you about 5 minutes to go through, but it just kind of walks you through all the different strategies that we talked about today.
Perfect. Yeah. And if what we talked about today makes sense to you and you want help implementing these things in your business, or you want to learn more about advanced tax strategies that we offer, reach out to us. We're a full service accounting firm that offers bookkeeping, tax prep, and tax strategies specifically for real estate agents. So I think Michael's going to drop our email address in the chat. So if you want to reach out to us that way or scan the QR code, you can set up a free strategy call with us. We'd be happy to talk about your business.
Yeah, and that middle QR code is a tax strategy guide with top 10 tips and ways that you can reduce your taxes as an agent. You can grab that too, free download as well. But we appreciate Dalton Wade having us here today, and we'll stick around. If there's questions, throw them in the chat. I'll throw our emails in there as well. But we appreciate y'all. Hope you have a great rest of the week. Happy holidays, and go make those smart tax moves that will pay off big.
Thank you so much, Michael and Jordan. That was awesome. I mean, it's really great stuff. And, no sense giving the government your money when you don't have to. Keep it, being a real estate agent is hard enough. And, I think, we've easily seen, tonight with some of the things that, Michael and Jordan talked about, where this is really, thousands and sometimes $10,000s for, in savings, right? That goes right into your pocket and as opposed to into Uncle Sam's pocket. So let me go through the questions and I'll see if maybe I can answer some. And if not, I will ask Michael and Jordan. So we had one from Mussolini. How are you? Could you repeat the percent of the meals that is deductible? And I think Kim was nice enough to put in 50%, which I think is the correct amount. So half of what if it is a business luncheon or a business dinner, half, can be deducted. Am I correct there, guys?
Yeah, that's right. Yep.
Yeah. All right. And then Karen said, if I'm going to an event or socializing to advertise my business in person, one-on-one with new people, can I deduct my meal, drink, etc. as advertising? And I think what Kim is wanting, instead of being able to deduct 50%, now she wants to be able to deduct 100%. Can she do that?
So typically, no. Meals, the IRS would say, even at an advertising type event, the IRS is always going to say there's a personal component of eating a meal, and so that's still going to be at 50%.
Thank you, Michael. So, and then we have from Mohammed, I use HRDLR for mileage and account for my real estate business. Awesome, Mohammed. You're on top of things. It's free with my Aura membership. So Aura, for those who don't know, is the Orlando Regional Realtor Association. So through his board of realtors, they offer this. Other boards, may or may not offer it. I do believe Michael mentioned, who was it, Michael, that you can have that app and
yeah, Mile IQ. A lot of them are the same. So Mile IQ, and I'll drop it in the chat. Mile IQ is the one that I've seen produces good logs, but a lot of them are the same. So find one that works for you is the most important.
And then Miranda was asking, does the that same app, HRDLR app, documentation suffice for tax deductions?
So I'm not familiar with that one, but typically the answer almost certainly is going to be yes. They're designed to create the substantiated mileage log that you need. And so you can ask them to double check, but most likely the answer is going to be yes.
All right. And then Glenn, I'm not sure on this. He's asking, what is the website for Focus? Does that ring a bell for either of you guys? I didn't, maybe he can clarify.
Not me. Yeah, not me.
I'm sure. Lisa's asking, hey, Lisa, will there be a replay? Yep, we are recording this and we should have the replay up on the Join Dalton Wade website sometime tomorrow, but it will be there. Miranda's asking, I'm a new agent. If I do not have any profits in 2025, can I roll my deductions into my 2026 taxes?
It's a great question. Typically no. There are some situations where certain expenses would be considered startup expenses. So this is one you're going to want to talk to your tax professional about. But typically what would happen, you're a new agent, you're probably filing under your personal name or as a single member LLC. As a part of your personal return, you're probably going to generate, if you have expenses and no income, you're going to generate a loss. That loss can be used to offset against your other ordinary income. And so you can take advantage of the loss and therefore you don't need to roll the deductions forward because you can offset against your other income. And if you don't have any other income, you can carry the loss forward, and the loss rolls forward as was part of what's called a net operating loss deduction. Is going to carry forward at least in part to the next year. So the answer is kind of, but you really need to talk to a tax professional to make sure you handle that one right this year.
All righty, thank you. So I'm sure many of you don't know this, and I'm sure Jordan and Michael might not know it either, but I actually was a CPA way back when, so I am dangerous here, right? I am dangerous. So got those guys to laugh. So all right, I'm going to answer Darren's question. Darren says, use 60K on 100K net profit as reasonable salary when talking about using the S Corp. Is your general rule of thumb for your clients 60% of net profit can go towards a reasonable salary? Are there cases where you may advise increasing that percentage? Actually, what you'd want to do is lower that percentage, right? You want to have the difference between, right? Because there you're only getting 40K, remember? And then you're saving 15% on the 40K, 6,000. But hey, if you used 40K as your reasonable salary and you still made 100K, then that's 60,000 times 15%. So then you would have saved 9,000, right? So if that lower, the higher the reasonable salary, the less beneficial it would be.
Yeah, I mean the trick here is the term reasonable salary. It doesn't really IRS doesn't ever really define what reasonable salary is. There's court cases and things that we can look at, but there is no standard definition of reasonable salary. And so we do look at substantiating factors in your business. Like for example, are there other people inside of your business that are working, generating some of the income? Things like that help us to understand what could be considered reasonable compensation. I don't have a rule of thumb, but as Phil said, you typically want to go down there and not up.
All right. Sheila's asking about her cell phone and other, she uses it both for business and personal. Can I deduct my cell phone or a percentage of it? What do you guys think there?
Yeah, so cell phone expenses, almost always deductible, at least in part. And so it's really going to depend. What IRS would say is IRS would say you should take a percentage of your total bill and remove that for personal use. However, oftentimes the vast majority of people that are self-employed, real estate agents being one of them, you can't operate your business without your cell phone. And so most agents can make a really strong case that their cell phone could be 100% deductible. The we usually do that. We can almost always justify 100% business use. You also mentioned app costs. I would say personal apps that are clearly personal in nature would not, in my opinion, be deductible. But apps that have some sort of business function or use, yes, would be deductible.
All righty, perfect. A bunch of thank yous. I appreciate that. Thank you, Shelley. Happy to do this. Absolutely. Let's see if we have any other questions. All right, we got Christy. How are you, Christy, up there in Charlotte? Good to see you. Do you recommend agents starting off with LLCs and switching to S Corp when the net profit's 50K, or staying, a sole proprietor, until they hit the 50K net? Maybe, Michael, you can talk a little bit about like the sole proprietorship, and when maybe somebody would think to switch to a corporation.
Yeah, so a lot of agents, when you're just starting, are going to be that sole proprietorship. And the reason that you would become an LLC is probably so that you can elect S corporation status. We typically recommend most agents go ahead and start as an LLC if their state allows it, the broker allows it, but start as an LLC if you believe that you're going to be getting to that 50K net mark. So a lot of times we just recommend you go ahead and do that. But in terms of when you elect S corporation status, so regardless of whether you're already an LLC, you're thinking about it, we would recommend typically that you start to have the conversation about becoming an S corporation, electing that S corporation status once you're consistently around that $50,000 net profit mark. And the reason for that, again, is just there's the costs associated with being an S corporation start to eat into the tax savings, because when you're under 50,000 in net profit, reasonable compensation, it's hard to not say that reasonable compensation is a large percentage of the amount under 50,000. So once you hit 50,000, have that conversation with your tax professional to say, hey, is it time? Let's do a cost benefit analysis and see if it makes sense.
All righty. Dion's asking, what about personal medical coverage? Is this a deduction?
Yeah, it's going to depend, right, on how you're structured. If you're talking about health insurance premiums, that's going to depend on how you're structured from a tax perspective. If you're a sole proprietorship or an LLC that's not an S corporation, those premiums are going to be deductible as what we would call, we call a front-facing or page one deduction. It's not actually page one anymore, but it's deducted against your ordinary business income on your personal return. And then if you're an S corporation, it's deducted as well, just slightly differently. But the general answer is health insurance premiums would be deductible to a business owner in some way or another.
Larry's asking, hey, Larry, how are you? He's asking, do you guys handle FERP declines? FERP is the foreign investment real estate Protection Act, something like that. It has to do with making sure if you're not from this
Yeah.
country, Uncle Sam gets their money, right?
We,
And typically, the title company wants something from a CPA firm, that says, hey, the FERPTA needs to be this or that. So do you guys advise
yeah,
there?
we don't. There's a number of good firms out there that we could refer to, but we don't.
So Larry, over at Turner Title, Lisa has a great recommendation. So, maybe email me that and, I'll get you their contact info. So you'll have that. Can I deduct the purchase of home warranty for clients? PMO wants to know, can I deduct the purchase of home warranties? I'm going to go with yes, you can. What do you say, Mike?
Absolutely. Yeah, absolutely. Yeah. I mean, any sort of cost that's associated with client retention, we would probably consider that a cost of sale. But yeah, absolutely, that would be deductible.
All right, Gloria wants to know how much can be deducted for courses taken? I would say probably the entire amount, but what do these guys say?
Yeah. Yeah, I mean, so IRS would say reasonable expenditures, right? So, and that typically, if you're paying for a legitimate course, reasonable would be whatever it costs. So, yes, it's typically would be 100%.
All righty, Jennifer's asking, yes, for vehicle deduction, how do we determine how much can be written off if purchased by year end? I'm looking at getting a new car. Awesome, but it might expedite if it will help from a tax perspective.
Yeah, it's going to help from a tax perspective, almost certainly. And so you're going to want to talk with your tax advisor because the rules are somewhat complex, right? It's going to depend on the type of vehicle. It's going to depend on potentially the weight of the vehicle. Because when I mentioned earlier, we got something called a Section 179, and we have something called bonus depreciation. There are limitations on those depending on the type of vehicle, the weight of the vehicle, et cetera. So yes, honestly, it's one of the biggest deductions that agents should be considering before the end of the year. So yeah, I would jump on, talk to your tax professional, as soon as possible to kind of get that ball rolling.
All right, we got a good question here from Sophia. In Florida, we can only use our names to conduct business. How does it work if I want to be an LLC or sub S? Do I LLC my name? Well, here's how it works, Sophia. So you have to set up either an LLC, a PA, or a PC. Those are kind of corporate structures, right? And then once you do that, we can get you the form. You then send in that to the DBPR, and they actually change the name on your license from your name to your name, LLC, PC, or PA, right? And then at that point, once that's done, you can elect the subchapter S, if I believe I have that correct. What do you say, guys?
Yeah, correct. That I believe that is absolutely correct. I can't speak to the specific law for Florida, but I believe what you stated is correct.
Yeah, that's how I mean, we get this, Sophia, all the time. So it's a common one. We know that. We have the forms. You just, submit, to the DBPR. You have to, register your corporation with Sunbiz. You got to get all that set up. Once you have that set up, you can apply to have your license changed to your name, to your company's name. And then once we see that, we can pay your company as opposed to you individually. All right, let's see what's next. It's not good idea to put your legal name as LLC or S Corp. Is so why? Well, again,
I don't.
Yeah, I
Yeah, I
think
don't recall.
in
Yeah,
Florida, and I know that's where you are, Mark, you have to do that. It has to be your name, LLC, PC,
yeah.
right? And then once you do that, you can make the election to be a subchapter S, and all is good. Hey, Eddie, how are you? Good to see you. Thank you for being here. Eddie's giving 2 thumbs up to the HURDLRF. All righty, we talked a little bit about that. Tarsha, how are you? Can we deduct, good question. Can we deduct car repair and new tires?
Yeah. So how it works, and again, it's going to depend a little bit on how you're structured, but typically we take either actual expenses on a vehicle, if it's a business vehicle, or we take the mileage deduction. So the mileage deduction, that's sort of this year it's 70 cents per mile. It's sort of all encompassing, and it includes kind of gas, repairs and maintenance and things like that. And so, yes, if you're taking your actual expenses, then yes, car repair and new tires. If you're taking mileage, then no. And so again, you're going to have to understand how you're specifically filing for tax purposes. So the answer is maybe.
Hey, Nicole, how are you? Thank you for being here. So Nicole's asking about like if you make less than 50K, then what is the approximate tax if doing an S corp? So again, I think really it's again, it's the difference because you're going to pay yourself a salary, right? And say your salary was 30,000, you made 50, 20,000, you're going to save 15% on that or 3,000.
Yeah.
That may or may not be worth it given, you're going to have to, have a payroll, process, right? So there's going to be some additional costs. I think Michael said the threshold is typically how much in profit, Michael?
50,000. We look at it right around 50,000.
Yeah, so like 50,000 or above, it probably makes sense. Let's see somebody, let's see if we have any else. Can you have an S, this is a good question from Nicole. Can you have an S corp and have multiple types of business income under the same LLC S corp?
Yeah, you could. I don't know why you would. So it's going to depend exactly what you're doing. But typically, again, we're not attorneys, but typically we've heard a lot of attorneys recommend that you don't commingle sort of different classes of business assets, different types of business activities together. We would typically not see those commingled, but it's going to really depend on what you're doing. So, for example, if you're a real estate agent and you own a car wash, I wouldn't put those two things together, right? But if you're a real estate agent and you also maybe, for example, do some photography work for other agents on the side, those two things I would consider having inside of the same LLC because they're similar in nature. But that's the only time I would really commingle things like that.
Cool. All right, Julian. Yeah, I don't use Messenger, so sorry about that. So, but as soon as we end this, give me a ring. I'm around. No worries. Um, uh, Zihu, how are you? Good to see you. I always say your name crazy, but it's a little tricky one for sure. She's asking if you have an electronic car. I would assume there's really no, an electric car. There's probably no difference between that and, a combustion engine car. Is that correct?
Correct. Yeah. Correct. Yeah.
Carolyn, good to see you. Thank you. I just purchased new tires today. Is any portion of this tax deductible? This is my work vehicle.
Yeah, same answers we did before. It's going to depend on whether you're taking standard mileage or actual expenditures.
Perfect. All right, Shelley, thank you. So Shelley, you'll be happy to know we did move forward with Stack Wrap and we're getting close. Shelley referred a great software company to us and you'll be getting some updates probably in the next week. We're getting ready to launch. So really appreciate that. Max and his team are great. Let's see, Jennifer, this might be too complex for today, but I already have an LLC to hold my rental properties as well as my marketing side business. Can I also elect to start using the same LLC for my agent business, or is it best just to start a new agent?
Yeah. So again, talk to your attorney, but almost every attorney is going to tell you that you should have all of those activities in separate entities. So you should probably have your rental property in a separate entity from your marketing business, and you should probably have your real estate agent sales business as a separate entity as well. It's going to depend a little bit on your personal, facts and circumstances, but almost always you should have those separate.
Hey, Susie, how are you? She's asking, are we protected better if we're an LLC or an S corp from a potential lawsuit? Here's my take. You're going to get sued, meaning if there is a problem, they don't care whether you're an LLC, S corp, they're going to sue you personally, right? And then you're going to have to deal with it. Typically, these things get resolved. We do have, errors and omissions insurance. So that's kind of a fallacy. I think is out there about like somehow, being an LLC shields you as a real estate agent. Personally, I mean, again, you could check with an attorney. They would probably know better than me, but just from experience, that plaintiff's attorney is not going to care. They're going to just drag you in.
Yeah.
So
Agreed.
again, we just want to be very careful when we're out there working, know our clients, right? And, make sure we have good professionals, good inspectors, all that stuff will certainly help reduce our liability. So Shelley mentioned, her accountant told her 100K, right? We've kind of talked about that. Let's see. Hey, Donna, how are you? Yes, this is going to be taped. We will have that, up tomorrow, so you can catch the replay. I'm typing in my phone number for Julianne to give me a call once we're done. It's in there now. Hold on. Cool. Let's see. Hey, Lily, how are you? For my S Corp, after taking out a reasonable salary, which retirement plan would allow the maximum deductible contribution? A solo 401k or a SEP IRA? Great question.
It's a great question. It's gonna depend on a couple of different factors. Both of those are good options. I think probably the solo 401k might be your better option there, but SEP IRA is a little simpler. Filing requirements are less. So usually in your situation, probably SEP IRA would be the one we're going with. But really, depending on what dollar amounts you actually are thinking about putting in there, like if you're not thinking about 70,000, if you're thinking about a lower one, there's something called a simple plan as well. It's going to depend too if we're wanting to do traditional deductible contributions or if you're wanting to mix in Roth contributions. A lot of different factors in there, but those are both good ones to talk to your accountant about which one of those might work for you. They're both good options.
Alrighty. Shelley's mentioning about, her home being protected as an LLC. I mean, that's probably true. I'm not sure, but if that's what your lawyer told you, probably good. So there is some protection. I think, your home is protected in Florida. In any type of bankruptcy, they can't get after your home. So it probably ties in the same way, but again, I'm not an attorney, so I don't know.
Yeah.
Christian's asking a good question here. If my LLC S Corp started on July 2025, can I deduct the expenses on or before July of 2025? Yes, you can, but you would be deducting them on that, Schedule C, your personal, right? And then anything after July, is going to be able to be on your LLC. So you're not going to take those expenses. Those are going to go on your Schedule C personal return. Am I correct, guys?
Yeah, I mean, there are some situations, Phil, where we would maybe pull, if it's not very many expenses and it just happened maybe very shortly before July, potentially we would pull those onto the S corporation return just for simplicity's sake, because the deduction is going to be pretty much the exact same. But the reality is, you're right. You probably are going to put that on the Schedule C and the rest of them on the S corp return. It's just going to depend on the amounts and the volume and things like that.
All righty, I'm a new agent. Should I start an LLC before we do any business? I mean, I would say, yeah, you could definitely do that. I mean, I think it gets you set up correctly right out of the gate. Certainly there's a little bit of a cost there, but you've already got good systems, and you're not, oh, I went half the year and then those expenses had to go on, right? So yeah, I mean, I think it's a good idea. What do you guys think?
Yeah, agreed. Yeah, no, I'm right there with you. I think it's good advice.
Yeah.
Cool. All right. Any last questions before we sign on? Great job, guys. Really appreciate it. I mean, I learned a lot. I think everybody else did as well. All righty. Anybody else? Thank you, Zine. Appreciate everybody being here. You guys are awesome. Taking the time out. Save money, right? I mean, that's the goal, right? Keep it in your pocket, not Uncle Sam. All right, everyone. Have a great evening. Thank you.
Thanks, all.
Thank you.
All right, guys. Thank you.
Bye-bye.
Bye.